Okay, hello everyone. Let's look at the markets. Wow, look at this. Sorry, I was looking at this before. Look at this move down in natural gas, down 8.7%. I mean, I was going to talk about stocks, but we could kind of start off with this. A lot of people, especially in the retail community, they don't understand that they can get exposure to commodities. It's not sophisticated, it's not complicated. If you could trade a stock, you could trade a commodity. You don't need to be a futures trader. There are ETFs that can give you exposure. So this ETF UNG is designed to track the price of natural gas. The chart looks different, and there's a reason for that. Natural gas is open basically 24 hours. So when you see the daily up or down, it's measuring it from midnight. Whereas if you look at the ETFs, they're only open from 9:30 to 4 Eastern time. So don't think that there's not a way you can get exposure because it is. Okay. If you're really bearish, you can look at the cold ETF, KOLD. I love the name for these guys. This is designed to move in the opposite direction of natural gas by twice as much. And if you're really bullish on natural gas, you can look at this Boyle ETF, which is designed to move in the same way, but by twice as much as natural gas. All right. Anyway, let's just take a quick look at the S&P, and then I want to look at the tech stocks really quick. So S&P, kind of a non-ish day, down a little bit. Ooh, it's actually down fairly good in the post market, about 60 basis points. All right. So as we talked about, sometimes markets are fairly easy to read. Sometimes they're complicated. Over the last, say, week or so, it's been pretty easy. The action has been all about Apple and Microsoft and Nvidia, of course, right? Trading at important price levels. So let me bring up Microsoft. And why did we say Microsoft was important to watch? Well, it wasn't range bound, it wasn't neutral. It got really oversold and it got to a level that was support before. Levels that were support can become support again. In the market, some price levels are more important than others. That's one of the most fundamental things that people don't seem to get. And when I teach new students, they're like amazed at how precise this stuff can be. I mean, look at this. Microsoft is a perfect example. Look at this $400 level. How do you explain that a company that has this market cap of $3 trillion can find this exact valuation at such different times? Well, it's because when we look at a chart, we're looking at psychology, people psychology. People sold at the support level, stock fires higher. They're like, oh, this sucks. I made a mistake. If it gets back to my price, I'm going to buy it back. So remorseful sellers who sold at the bottom here try to go buy their shares back if they get them at the same price they sold them at. If there's enough buy orders, it creates support. The next thing is some of the people that want to buy look around and be like, wow, we're at a support level. There are other buyers. I better step up the price I'm willing to pay because the sellers are going to go to whoever's willing to pay the highest price. So interesting action in Microsoft. But here's what I really want you to focus on, or at least what I'm focusing on. Apple, this important 168 level. All right. Now, this chart is bigger than it seems. The stock closed at 169. It's $1 above it. It's going to take a couple days here. But again, here's another example of psychology. Now we have buyer's remorse. People bought and the price goes lower and they tell themselves, I made a mistake. If it gets back to where I can get out of break even, I'm going to. So sometimes support levels become resistance. Now, I know from the chart it looks like it's above it, but it's going to take a couple days. It's only $1. It's a $169 stock. But sometimes markets are complicated. Sometimes there's just a couple things to focus on to give you an idea of what's going on. And this is one of those times, and it has been with this tug of war between Apple and Microsoft. So testing resistance, Nvidia, look at this, got to resistance and fell apart. Now, this is a precise level. I mean, I've been doing this a long time, longer than I care to admit, actually. Back in my day, people used to say quarters and eighths. I mean, I'm old, but I'm immature, so that's cool. Look at this, 840. There were people that are like, oh, if this gets to 840, I'm going to buy it. They put a floor under it. Eventually, the straw breaks the camel's back. The last person who needs to buy shares buys them. There's no more buyers. The stock goes into a free fall because the seller's got to really just be really aggressive and put stuff out at a discount. Anyway, we get back to 840, and what happened? You get these remorseful buyers placing sell orders. It converted the level from support into resistance. What happens next? Some of the people want to sell, sense, oh, other sellers must be coming into the market. That's why the prices are going higher. I better sell. And they start to undercut each other. All right. So, all right, everyone. So that's it. Just some kind of real time technical analysis. I don't like the term technical analysis. I am a CMT, but I do disagree with a lot of the stuff they teach. I just think a lot of it's bogus. I was an institutional trader for 20 years and traded for some of the best literally in history. Mario Gabelli, Steve Cohen was a market maker, yada, 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 yay me. Bottom line is this. What I've learned over the years is it comes down to this. What are the important price levels? What's the trend? What's the momentum? And what's the psychology? When you get a situation like we had it with Nvidia or in any bubble type atmosphere, the cannabis stock, I'm sure people who are listening to me are old enough to remember the cannabis bubble. I mean, gosh, we had stocks that were $300 a share that are now penny stocks. I don't think that's going to happen here because these companies actually earn money, but it just shows you the psychology. Now, why does a market go down? Well, why does a market go up? A market goes up because people want to buy. It's a bidding war. Someone wants to pay this. Someone else sees you and they're like, oh, you know what? Or sees that person like, I don't want them to buy. I'm going to get ahead of them. They bid up, the next person bids up, so forth and so on. They outbid each other. That causes the price to move higher. Now, when the very last buyer who wants to buy buys their shares, if there's no one left to buy, the price can't go higher. I don't care what the future earnings are. I don't care what the prospects are. Markets are psychology and supply and demand. If there's no more demand, if demand has been exhausted, supply will push the price down. All right, everybody. Thank you so much. Hope to see you soon. And yeah, I'll see you then. Thanks.